So just a little bit of a disclaimer here. As always, we're not tax or investment experts. Everybody has their own goals, objectives with investing, purchasing real estate. Both Carmelo and myself are professionals working in this industry. So, we do have a certain way of kind of looking at this, but please do your own due diligence. Don't rely on anything that you see in our presentations as legal advice. Make sure you get, appropriate professional third-party advice where necessary. Right? Yeah. Carmelo, go ahead.
So, hello everyone. My name is Carmelo Boutis. I'm a mortgage agent. I've been doing mortgages for over 20 plus years, and as an independent agent, I work for a brokerage called yourmortgageyourway.ca. Proudly Canadian. One thing I love with what I do and doing mortgages for over 20 years, I actually started my career as a mortgage underwriter. And for those who don't know, a mortgage underwriter, they're the person at the bank that reviews your application and makes the decision whether you're going to be approved or not. So the very first thing I learned in my career was how the banks think, what they look for when it comes to approving you for a mortgage. Now, as an independent agent, I work for you. I have no loyalty to any really one bank. It's whoever offering the best mortgage product, rate, and terms that matches your needs. And last year alone, we used over 59 different lenders at Your Mortgage Your Way. So it goes to show that there's more than just the big five out there.
Yeah, definitely. And, Carmelo, thanks for leveraging those relationships with the different types of lenders. If any of you were able to join us at 6:30, we had First National, Daniela and Anthony join us for a webinar. We've had other, lenders join us before. So thanks, Carmelo, so much for, using your network to kind of expand and add value.
Thank you. And I just added our socials in the message board.
Yep. So at Carmelo Mortgage, I know Carmelo is now upping his social media game. We're expecting to see at least one post a day moving forward from tomorrow.
I'll try to get at least a few videos before the end of the year.
Okay.
I'm really on videos, and I'm happy with the one I did last night.
Okay. Yeah. Nice. Yeah. Slow, sustainable growth. Right. That's what it's all about. This is me. My name is Alex Vanietsky, realtor of Remax Condos Plus. Over a decade in Toronto's condo industry. I've been a real estate investor since 2013. 2022, I was in the top 1% of GTA condo sales from over 70,000 Toronto Regional Real Estate Board realtors. If anybody wants to scan that QR code, it will take you to my link tree. If you want to connect with me on social media, it's at alexz.realtor on Instagram and The Mindful Agent on TikTok. That's something that I'm starting to now explore and move forward with. So enough about us and more about types of questions that we hear. So Carmelo, I get this question a lot.
So Alex, yeah, let me know. What are there any limitations to a home inspection?
Okay, so first off, for anybody who may not know what a home inspection, like what we are referring to when we say home inspection. So normally when somebody purchases a property, a condition that they may want to include is that the sale of the property is conditional on getting a home inspection report and being satisfied with that report. So essentially, you're bringing in a certified home inspector. They're going to be doing a report for you. It's pretty much like a cookie cutter type of template where they fill in blanks and then it generates a report at the end that talks about the overall condition of the home. So this is a great product. It adds a lot of value and a sense of security for home buyers, but one thing to understand is that it's also a very limited product. So a home inspector is more of a generalist. They're not a specialist. So as far as, providing advice for you on, wiring or plumbing, it's only like if they see or notice something. They're not doing a deep dive. They're not like snaking the drains or, running various tests. They're not going to areas that are not easily accessible or visible. And there's always a big disclaimer in any home inspection that there's no, guarantee of future performance based on this inspection report. It's just for informational purposes only. So it's a great product to have, but there are, limitations to it. I wouldn't count exclusively on it. Like, for example, I had clients that I was working with earlier this week. We were looking at a property that was a little bit older and looked like it was, more custom built by the seller. And because of that, we included like not just a home inspection condition in our offer, but we also included a condition for an electrician to come in and provide a report satisfactory to the buyer. So there are limitations to that, Carmelo.
Oh, I agree. And again, one thing that happened with my mother when she bought her home last year, we had a home inspection done. And when you get a home inspection, their report is only going to show you the defects. It's okay that there's no such thing as a home with no problems to it. You just got to take it in stride. So that's a really good answer. And I like your solution with regards to the offer you made this week.
Yeah. So, one thing that I recommend to sellers, however, with a home inspection is that we actually usually get a home inspection at the time of listing a property. So the reason why we do that is that we want to be transparent with any potential buyers and, eliminate the need for them to, bring an offer to us with these conditions. We're kind of being, upfront about the about the condition of the property. So home inspection is a great tool. Is it going to, capture every defect? Absolutely not. Is there any warranty around it? Absolutely not. But it will give you a peace of mind and also some ability to strategize and plan for the future, because they can, look at the roof and they can tell you, okay, 5 years from now, you may need to replace your roof. It's at the, that kind of, 60% of its lifespan is done. So good for future budgeting, but it's not an all-encompassing report like many may believe. So Carmelo, I have a question for you. I know you get this question a lot. I've asked you this question myself. So what is your lowest interest rate that you can offer me?
Full disclosure, Alex, I do not lend any of my money. So it's I don't offer an interest rate, but the banks I work with, the lowest rate I have available is 5.25%. How does that sound, Alex?
That sounds like a really good rate. I mean, that sounds like it's below market, because I know that many people who are buying principal residence now, they're looking more at the 6.5%.
Well, the key thing is when you look for interest rates, a lot of people go online and they see these catchy rates. This is a legitimate rate, but this rate is only available it's a 6-month fixed rate mortgage. It's only available for those looking to purchase. It needs to be on an insured mortgage, which means you are paying the mortgage default insurance. There's no pre-approval to get with this rate. There's rate hold. The maximum is 120 days with an approved application, which means you've actually had to buy something to get this rate. It is always subject to change without notice, and you got to fit the affordability guidelines. So getting a mortgage, the lowest rate, you may not want a 6-month fix.
So is the affordability guidelines for something like this a lot more, are they much more, so I guess, really picky about it? Are they looking for a really kind of somebody who's, has very low debt? What are they looking for?
No, they're looking for the cookie cutter, straightforward client, which really everybody's so different nowadays.
Yeah, I saw somebody advertise a 3.99%.
That is again a 6-month most likely.
Mm-hmm.
You got to read the fine print, and that was old. I know. I saw that online. I contacted them. They just never updated their website. So when you look for interest rates, if you ask me, Alex, what's the lowest rate? There's really a lot that comes to it when it comes to getting a mortgage and an interest rate for me to quote you. There's things I need to know. I need to know whether you're purchasing the home. And with all the banks I work with, if you're buying a home, they have an interest rate for those who are buying with less than 20% down payment. They have a different interest rate for those who are buying with 20% down payment and the 25-year amortization. And they also have a different interest rate for those who are putting 20% down payment with a amortization larger than 25 years. You could be looking at just transferring your mortgage from one bank to another. Is your mortgage up for renewal? You may be looking to refinance. Those that are looking to refinance, the banks offer different interest rates than those who are purchasing. And things that also impact your interest rate is your credit history. How much money do you make? What's your income like? What's your affordability like? These are all the factors that the banks look for when it comes to giving you an interest rate. So those who call me and ask me what's your lowest interest rate, I don't really know anything about you, so I really don't know what you qualify for. So quoting you 5.25, they don't do any justice.
Yeah, I mean, I feel like when banks, I mean, I feel like I know that when they throw out numbers like this, it's just to kind of catch and get people in. But then you reach out and then you find out that it's okay. It's not really as simple as it seems. And like, look at all these different, qualification guidelines and criteria. Like everybody's different. Like we're so, in 2023 going into 2024, people have so many different situations, sources of income, gig workers, full-time contractors, self-employed, everything. Like it's all over the place. So, you're right. I mean, you could say, hey, I have 5.25, but it would really be like a disservice to the client, because once they find out that maybe they don't qualify for that, it seems like based on all of this, that majority of people may not, or the term is not going to be the right fit for them. It's just going to leave a bad taste in their mouth from that interaction. So that's not, I know we talk a lot about kind of building relationships here, not over transactions. This transactions, but no relationship out of that. You're just going to ruin the relationship.
But that's exactly it. And I'm here to help people, right? So once I understand everything, then I could kind of get a better understanding of what you're looking for. And sometimes it's not always about the rate. Maybe you're looking for something where you need to get more approval for a larger mortgage that your bank didn't give you.
Yeah. Or customer service. You need
Yeah. And if the competitor is only, if the difference is like 0.05, 0.1, really you're not asking about the rates. You're asking about, I need help because of, I need to buy this home, or more, my mortgage renewal, which is, there's a lot of mortgage renewals coming up in 2024. The banks aren't offering you the best rates up front anymore.
Yeah, very interesting. Well, that's a very great point, Carmelo. So here's a question that I get asked a lot.
So Alex, I want to know, how do I know if the condo you're showing me is good? How do I know if this is a good condo?
Yeah, I mean, that's pretty much like as subjective as this is your interest rate thing, because we have like hundreds of condos in the Greater Toronto area. I think we're one of the largest, if not the largest, condo market globally in the world. More and more freehold properties, like, detached homes and things like that, are being torn down. Condos are being built. Everybody's going to be living more and more vertically than they already are. And when you own a condo, as opposed to a freehold property, you own your unit, and then you also own a proportionate share of the common elements of that building. And as a unit owner, you're responsible for maintaining them through your maintenance fees. And, you may need to put additional money if there's a special assessment. I know that lenders, Carmelo, correct me if I'm wrong, but, they do qualify you as a buyer, but also most importantly for them is actually what is the property that they're lending the money on, correct?
Correct. The property is their security. They're lending you hundreds of thousands, if not millions of dollars on a property. If the property is, like, for example, a condo is poorly maintained, they don't want to do financing on a property that they may not be able to sell. It's just managed poorly.
Yeah, I mean, we've seen that, right? And I had an example in the summer where, there were buyers that were working with another agent, but they were not able to, they thought that they were going to get a certain type of financing, and then when the lender saw the status certificate, which is basically like the financial documents and the governance of the condo corporation, it tells them, things about their operating budget, about any special assessments, about any legal matters against the condo corporation. You get the minutes from the last annual general meeting. You learn about the reserve fund from there. So when the lender actually, saw this, they required that they come up with a higher down payment, because I guess they saw that as a more risky purchase.
Yeah, the property, the reserves might have been too low, and there's a good chance that there'll be a special assessment where the client would then have to, the buyer would have to then maybe pay an extra $200, $300, $500 per month, and that's not within their budget and affordability.
Yeah, so this is kind of like the first part about determining if it's a good condo, and that's just like, this is all math and documentation. Whenever you do an offer on a condo, I always recommend for my clients to put a status certificate condition in. So basically what that means is that it's a condition for the buyer's lawyer to review the status certificate that contains all this information about that condo corp, and then provide feedback to that buyer about their findings, so that they can determine if this is something that makes sense for them. and at the same time for the for the lender to review it as well. But yeah, so that's kind of
great.
what that's all about. But it's not just about sorry, there's some feedback that I'm getting from your mic, Carmelo. I'm going to mute you. Much better. So yeah, but it's not just about the status certificate. It's not just about the finances, but it's also about like that condo being a good fit for you as somebody who's going to be like living there. Like, does the location make sense for you? Are the amenities the types of amenities that you're going to be using? A lot of times I get buyers that they want to have a condo that has a swimming pool, rooftop terrace. They're looking for all these amenities. We find them a condo. They pay a premium because it has all of this. And then when, I talk to them 6 months or a year later, they've never been in that swimming pool that they really needed to have. So I'll be more focused on, location, the size of the unit, the affordability. Does the community work for your family? Is it the right type of demographic? Like some condos, for example, permit things like short-term rentals. So Airbnb or Vrbo. Like, I don't recommend for an end user, like if you're buying a condo that you're going to be living in yourself, I don't recommend for them to go and necessarily purchase in a building that permits short-term rentals, because there's going to be less sense of community. It's a more transient community as well. You're going to always have people coming and going. They're there for a week. They're there for a couple of nights. They're in Toronto from out of town. They're here for a bachelor party, or, for some sort of sporting event. So it's, not an ideal living environment for many people. Like, I've had, people that have moved into buildings that allow short-term rentals, and there was a lot of complaints, lots of fire alarms, elevators going down, and that's just kind of part of it. Like, you're essentially living in a hotel, so that's not for, that's not for everybody. So Carmelo, if you want to unmute yourself, can you? Yeah, there you go. Yeah. Okay, so Carmelo, I have a question for you. I'm going to mute you again because I keep getting feedback. Carmelo, I have a question for you. I make around 130 to 140,000 a year. I have a 725 credit score. I have $30,000 for a down payment. I can also increase it. How much mortgage do I qualify for? I know this is a question that you must get asked a lot, because I know that a lot of times when we do these webinars, these are the types of questions that we get from participants. So I want to know, what do I qualify for, Carmelo? Not to put you on the spot, but
I'll be honest with you, Alex. Right now, you don't qualify for anything. That's not enough information for me to do the calculations. And more importantly, I also need a calculator to do this. And the example, that question that the customer you kind of broke down, is actually somebody who messaged me about 6-7 weeks ago, the exact same numbers. Once I got an application, I learned quite a few things, which you don't really get at the beginning. When it came to the income, they've only been at the job for 6 months, and they had a job where they had a base salary of $50,000, but they have sales targets to earn commission. If they reach that sales target, they would earn another $80,000. So that's where that $130,000 came from. Plus, if they hit the sales target, they could, not guaranteed, get a bonus up to $10,000.
So everything else to align.
So without knowing, I hear the income all year, income of 130, 140, that sounds great. But once you get to the roots of it, the banks need to understand how is that income calculated, derived. The same thing when it comes to the credit. Banks don't only look at credit scores. 725 credit score is a good credit score, but for someone who's just discharged from bankruptcy within six months ago and only has one credit card, explains why the credit number is so high. The down payment, the $30,000 they had, it's only $10,000 in their savings, and they were pre-approved for a $20,000 loan.
Oh my God.
So the one positive was they could get up to, the parents were able to lend them $200,000. Like that, banks are okay with parents gifting money to children. Nowadays it's been happening a lot more often in the last decade, believe it or not. The inheritance while parents are alive are given to their children early. They want to see where that money's going while they're alive. So the down payment was fine, but everything else really didn't quite add up. So if I kind of did some numbers over the phone or email, or I did a video meeting and I got my calculators out, it all would have been wrong.
And it would have been risky, because a lot of times I come across, buyers, whether it's in an open house or just somebody that, gives me a call, and they're, looking at a certain type of property. They want to put an offer on a property. I've asked them, do you have a mortgage pre-approval? They do not have a mortgage pre-approval. And they're just playing with fire when you're doing that. I mean, like, honestly, I feel like the first step of finding a property it's not finding a real estate agent. It's finding a mortgage broker, getting a pre-approval, and then knowing what is it that you actually can qualify for, what can you afford, getting that pre-approval on paper. And I know, Carmelo, like, for example, we were talking before, like, you have a whole process for pre-approving somebody.
Oh, to be approved, to get pre-approved again, you have to actually apply. That is the key thing. Because again, just putting general numbers, I don't want anyone I work with to go out there to buy a home, and all of a sudden, when the application comes in, I was missing details. It changes what they qualify for. Then all of a sudden, somebody bought a home, put their life savings as a deposit, and then they can't get financing.
Yeah, you don't want that on your conscience.
No, again, I'm here to provide service.
Yeah.
And again, to help you. There's a lot to it. It's not a matter of. I know a lot of people who've used online calculators who've went to their branches, and the branches said they quote unquote pre-approved them, but they never sent in an application or employment documents. Afterwards, contact me, and it's like, well, if I would have done the pre-approval first, you would have been in this situation.
Yeah.
So when you want to get to know what you qualify, you actually will know if you apply. I look at employment documents. A credit check is done. If you're really buying a new home, verifying where your down payment is coming from. Because verifying where the down payment is coming from is very important. The banks have to deal with money laundering, and I know people here on this webinar are not laundering money, but the banks have to go through it, and we have to get all that cleared up front.
Sounds good. Okay, and I guess I kind of started to answer this question before.
You did. Alex, how do you know if, especially the building we're looking at, how do you know if this is a good condo?
So, we talked about all the financials, the status certificate, having the lawyer review it. But, this is kind of like what it comes down to most importantly. So like I started to say, like, people get fixated on amenities and nice to haves. Focus on your actual unit and your living space. And is that actually going to be, a fit for you? Is the location a fit for you? Is the community a fit for you? Are you looking for a younger community or an older community? Because Toronto is such a hot condo market and we have so many different condos, there's different fits. Like, for example, if you have pet allergies, you can go move into a condo that's pet free. And the total opposite. If you're a pet lover and let's say you have 2 large dogs, you need to find a condo that permits that, right? So it's all about, lifestyle and that condo being well managed. Like, one of the things I talk about this a lot. I like older condos. Okay, I have kind of a bias towards them because the floor plans are bigger. You get more square footage. There's more parking available. Every unit generally comes with at least 1 parking spot. Lots of units come with 2 parking spots. Just good square footage, good sense of community. But one thing that I find in older condos is that they're either really, really good or they're not good. There's kind of like they're on those opposites because, deferred maintenance eventually catches up to you. So if a condo has been properly going through, its life cycle, if it's had, engineering studies done in a timely manner. The board of directors has been on it. They've been putting money aside for maintenance. They've been fixing things when they're supposed to be fixed before they break down. It can be a great community. And I see condo buildings that are, 12, 13, 1,400 square feet. They have maintenance fees that are like $800, which is like 60 cents per square foot, well below market average in the GTA. And then these maintenance fees include everything, like all utilities, because they got group rates that they locked in, even things like cable TV and internet. So, these things are out there, and ultimately, it's like every condo is going to age. It's about how it's maintained and how it goes through that cycle. It's not about being penny wise but pound foolish in the future. That's ultimately what it is. And I think that actually, sorry, I made a mistake. Like these slides should have gone together, but I just wanted to kind of take the opportunity to go a little bit deeper into how I know if it's a good condo. Now, Carmelo, I want to get a pre-approval for a mortgage. I don't want to ruin my credit score. I mean, I've heard that, these credit checks are going to, make my score go down. Can you do a pre-approval without a credit check? I'll just send you my report from Borrowell.
Unfortunately, no.
Good answer.
I'll be honest. Again, if you're looking to get a pre-approval, I do a credit check. They are hard checks, but there's one misconception with the industry and especially the media. Credit checks only impact your credit score by no more than 10%, and one credit check only shows you what your score is. It doesn't change it. There's 5 things that impact your credit. Your payment history is the biggest contributor to your credit score, 35%. So if you make at least the minimum payments on time, it helps make your credit score go up. The second thing is your debt level. How much of it do you use? Do you have a balance of $5,000 on a $5,000 credit card, or do you have a $5,000 balance on a $20,000 line of credit? How you use your credit and how much of it do you use impact your credit score way more than just a credit check. And then also, how long have you had your credit for? This is one thing I always talk about: is never, ever, ever cancel a credit card. Just stop using it. I have one credit card I use only once a year because I've had it for like over 20 years. And if I ever need to borrow money, the bank doesn't know how often I use it. They just know Carmelo has this one credit card for over 20 years and never missed a payment.
I was about to cancel a credit card 2 weeks ago because I got really pissed off at their customer service. And then I'm like, I've been with this bank for 15 years. I'm like, I'm not like, I was like telling them already, I want to cancel. And they're like, okay, we got to transfer you over to, and then I remembered you always say this. And then I just hung up.
Yeah. Don't ever cancel a credit card. Don't ever cancel a line of credit. Just stop using it. I've always, if grab that credit card, put it in a Ziploc bag, throw some dye in there, throw in the freezer, and you're done with it.
Okay. So, let me ask you a question about this. Okay. I see level of debt, right?
Yes.
So this is, I guess, how much debt you have as opposed to how much credit you have available or earnings you have?
Your balance, the balance of the credit card versus the credit amount you're able to borrow.
Okay, so how does all of this work if, let's say, maybe I just finished medical school, I have student loans that are like, maybe I don't even know how much this costs, like 150,000, and I have no income yet because I'm only starting to get into the workforce. How would this work? I mean, I guess I wouldn't be buying a home probably, but I'm just kind of curious.
Well, Alex, if you just graduated medical school and you're a doctor, there's actually a program for doctors that could get into the market without even, you're just getting into your career. So that's another, maybe we could do a presentation about that next time. Is there
one for realtors?
No, there's nothing for the referrals. Actually, there's a new program for realtors that are incorporated, but we could do that. Maybe we could do the presentation just about products that are out there, specialty products.
Interesting.
So when it comes to your question, let's speak about students in general, Alex. Equifax credit agencies, they recognize it's a student loan. It recognizes that there's no payment history on it, and it recognizes once it starts on a payment that the balance is high versus the limit, because it converts to a loan. And if you have a loan where at the beginning, it's not going to make your credit score go down because it recognizes this loan is now active, monthly payments are made, and balance only goes down. It's more that the debt level is with regards to, or anything that's revolving, meaning you could borrow money and pay it back like a credit card or a line of credit. If credit cards, there's you get a lot of different answers, and unfortunately there is no one answer. I try to simplify it as best as I can. If your balance or your credit available is really low, like $1,000, $2,000, $3,000, $5,000, you want to keep the balance on that no more than 50%. If you have a large credit limit, 20,000, 25,000, 50,000. You could probably go up to like 65%, maybe 70, because it's just really, there's a big difference. If you're using a credit card with a $2,000 balance and $2,000 limit, and your balance is 1,500, you're almost maxed out. $500 is not really not a real big difference. If you have a $20,000 line of credit, and let's just say you want to use 70% of it, 14,000, you still have 6,000, credit available to use. So
Yeah.
it's really case by case. If it's small limits, keep the balances small. Larger limits, again, try not to go too high, because the credit report and the Equifax TransUnion, they see the balances changing. If they see the balance constantly going up, then it sees and recognizes that you're only borrowing money. You don't have the ability to pay it down.
Yeah, I see that on my borrow well reports, because like I think that like monitoring credit is really important. Like people, I know that there's a lot of people might get shy or something when it comes to providing their financial information, or even just checking your credit score. I mean, maybe it goes back to like how we all wanted to get a good grade on a test before or something like that. But at the end of the day, like it's about doing a gap analysis. So like if your goal is to get into home ownership or buy your first investment property or create a portfolio of investment properties, you gotta kind of know, you have to like reverse engineer that, right? Like it's like, okay, where do I need to be to qualify for that? Where am I today? How do I, what steps can I take? Like, how can Carmelo assist me by kind of coaching me to, get either my credit score, my savings, my down payment, whatever, to a level that it needs to be, so that I can afford to, get that family home that I'm looking for.
That's exactly it. And again, a credit check is only a check. It doesn't take your credit from excellent to poor. You're looking at whether you're buying your home, refinancing your home. This is your biggest investment. You're borrowing hundreds of thousands of dollars. Doing a credit check is part of the process to getting the approval and giving you the right answers.
Yeah.
So don't be afraid to do a credit check when you're applying for credit. It just gives out information. And I've seen, Alex, time and time again, somebody who I do a pre-approval for. And sometimes before there was a time when people kept on making offers and they weren't getting accepted. It took 2, 3, 4 months for them to finally find a house. And when I did that, I had to, my credit check, by the way, is good for all the banks I work with for 30 days. When I had to do that second credit check 3, 4 months later, Equifax TransUnion, they see it's coming from the same provider. And some credit scores actually went up by a lot. And it's not because of the credit. It's because of all the other factors.
Very nice. Very nice.
So, Alex, I want to know, what are the different property types out there?
Again, a question I get a lot, but it's like, it's kind of given to me like in a different scenario where, somebody's going to look at a townhouse, or they want to buy a townhouse. And then when I ask them, are you looking for like a condo townhouse, freehold, parcel of tied land, they kind of glaze over. And then I realize that I've lost them. So, generally, like there's much more property types than just this, but we're going to keep it to like really simple residential. You're generally looking at 3 property types, like 2 really. The third one is kind of like in between. So a freehold property, you own your structure and you own the land that it's on. It can be a detached house. It can be a detached linked house. So what that means is that is basically, it looks like a detached house, but it's connected to its neighboring property through the foundation underground, which generally you don't see. I've also seen detached linked houses where they're connected at the garage, which you do see, but that's a lot more rare. Semi-detached properties, townhouses, you own the land, you own your structure, you're responsible for maintaining your structure. Something happens, it's all on you. You don't pay any sort of maintenance fees, but all the utilities, everything comes out of your account. That's a freehold property. In a condo property, you own your unit and then you own a proportionate share of the common elements, like we talked about, maybe 10 minutes ago. So you pay maintenance fees, that maintains the common elements. As a unit owner, you're responsible for your share of it. So like if there's 100 units, you're responsible for 1% of those common elements. It can be a townhouse or it can be a unit, like just like a condo apartment. And I was actually at a townhouse complex today where it's a townhouse, it's a condo townhouse complex, and right next to it is just like a freehold townhouse complex, and you wouldn't even know the difference because everything look exactly the same. It's just like on one side of the street, those are all condos and they're part of the condo corporation. On the other side of the street, there's no condo corporation. So it can get a little bit confusing. And then there's also something that's kind of in between, which is a parcel of tied land. So the best way to explain parcel of tied land is you own your structure, but you don't own the land. The land is a condominium corporation. The land, it can be a golf course. It can be just like a normal land, like a normal piece of land, like a driveway where you pay parcel of tied land fees, or they're known as common elements fees, but they're substantially lower than condo fees because the structure itself is on you. You're just paying for things like garbage removal, snow removal, landscaping. That's basically it. So there's generally three, and then there's also something that's called co-ownership or co-op. Now there's co-op like low-income housing co-op, and then there's a co-op which is co-ownership co-op. So one of the main differences between a co-op and a condo, because they may seem similar, it's usually an apartment, is that in a co-op, you purchase a share of the co-op. So, you own, I don't know, 2% of the co-op, and your unit is assigned to you. You don't actually own your unit. So now one of the things that I see a lot when co-ops are advertised on the MLS is that, like, right in the broker notes, they identify, for those agents who may not know that, this is a co-op, traditional financing is not going to work. You're going to need to go to a credit union. You need to have like 35% down, all these different criteria. Do you have much experience with co-ops, by the way, Carmelo?
I've had one inquiry this summer about a co-op. Because with a co-op, the credit unions, they don't do an actual mortgage where they can't secure that money on title of that property. I do mortgages. Unfortunately, I don't do financing on co-ops because they're just special types of financing. I direct people where to go. Because usually the credit unions that could do the co-ops, because they do the financing on the full entity. And that as the buyer, they only own a share, like a stock. Like they only own they don't own that unit where they live in, like you said. Yeah. They own a percentage of the whole community.
So when you say that, do you mean that like let's say there's co-op at 123 Main Street. If I wanted to buy a unit there, there's a credit union that deals with that particular co-op?
Because I don't do too much financing on it. I rather, all I know is the credit unions, they know which co-ops they want to do financing on, whether they're not necessarily partnered with them, but financing are usually done with credit unions.
Yeah, and co-ops is something that's starting to phase out. I'm going to mute you again. Co-ops is something that, is like, there's not a lot of them. I mean, I do see the occasional co-op buildings. Like we have like a handful in North York where I live. But it's just kind of like they're a lot of times older, and it's just, I guess it's something that used to be a lot more popular maybe in the 80s and the 90s, but now is not a form of ownership. And like another difference in a co-op and a condominium, though, that you need to be aware of, and I think this is one of the reasons, like another reason why traditional lenders may have a challenge, is that things like the Condominium Act, which regulate the condominium industry, they tell you about how much you need to contribute to the reserve fund. They basically set out minimum standards for condos. Those don't exist in a co-op environment. So it's totally up to the people that are running it. Like if they don't know what they're doing, it can become a huge liability. So a lot less standardization in co-ops.